Yo, what's good everybody? Welcome back to another video. So in this video, we're going to be moving on and slowly start going more in depth on the market itself. So what we're going to be covering today is supply and demand. Now, all we're simply going to cover in this lesson is supply and demand and the basics of supply and demand. Now, when it comes down to supply and demand, this is going to be the foundation of our trading methodology, meaning that behind almost every single trade that we take, supply and demand is going to be one of the top reasons that we're going to be taking that trade. Now, why trade supply and demand is very simple. It's simply because that's how the market moves. There's lots of different strategies out there that you could potentially learn how to trade. A lot of them may not make sense, but supply and demand has always been the one strategy to me that I found the most profitable, simply because that's how the market moves. Now, I can cover the reasons why I'm going to be trading, or why we're going to be trading supply and demand, such as risk to reward, such as it gives us better areas to place orders, along with where we could place our take profits and our stop losses. Along with it gives us better price action signals on where we could take the trade. There's so many reasons on supply and demand and why we could trade or why we should only really be trading supply and demand. But again, the main reason that we're going to be trading supply and demand is simply because that's how the market moves. Now, let's just kind of get right into it. What supply and demand is that when there are prices in the market that are more desirable for both the buyer and the seller. For example, let's say gold is trading at 1,700 from its original highs at 2,000. That is going to be a more desired price for the buyer than it is going to be for the seller, because it's already at a discount. It's already cheap, right? So when we talk about supply and demand, and when we're talking about desirable prices, the lower the price range gets, meaning if gold is trading at 2,000, right, and it starts going from 1,900 to 1,800 to 1,700, price is going to increase on desirability for the buyer to actually start taking buy orders to look for that asset, being gold, to continue to go back up so he can make a profit. Now, the same thing is for the seller, just simply vice versa. Let's say gold was at its original highs at 2,000. And now gold is at 2,001, 2,002, 2,300. Price is gonna start getting more and more desirable for the seller to look to actually sell gold to make a profit. It's very, very simple. Now let's take this for an example on how supply and demand works. So let's just say you're in the shoe game, right? I'm just gonna throw a random example out there. Right, but let's just say that you're looking to buy this one pair of Jordans that the retail price for that specific shoe is $100, but you see price maybe had gone down a little bit, whatever the case might be or let's say you were able to get a deal for buying 80% of the supply for the shoe. You were able to purchase 80% of the shoes for $90, right? Automatically, when you buy 80% of what the supply of the shoe is, right, the demand for the shoe is going to increase because there's a lack of supply. The shoe, in theory, is going to be more rare because there's not as many shoes on the market available anymore. So the shoe itself is going to increase in value. So now let's say you sell all your shoes for, again, all 80% of your shoes that you own for $120, which you purchased at $30 a shoe, or you purchased at $90 a shoe, you're simply going to make a $30 profit. And again, you buying the shoe at $90 is more desirable for you to buy the shoe at that price than it was at $100, because you're able to make an extra $10 profit per shoe that you own. And it's as simple as that. There's no need to get any more in depth into it. Now, you could look at really any market in general. Let's just say, let's just take a look at the real estate market, right? Let's just say the real estate market is down. It's down 10%, and a house that you saw selling for $1 million is now selling for $900,000 you're going to be more inclined to buy that house because it's cheaper. And when the market goes back up, hey, instead of making an extra 5% or whatever the case might be, let's say the value of the property itself goes up to $1,000,001, you were able to cash out almost a $200,000 profit because you bought at a lower, more cheaper price, right? So I'm gonna go back to here. It's literally the same exact thing. And you can look at what's going on nowadays. I'm gonna give you some real life examples of supply and demand. You could look at what's going on nowadays with the car market, inflation being at all-time highs, along with, things with the pandemic and the vaccine and everything else. Every single market has been going like crazy. The stock market has been going up like crazy. The real estate market has been going up like crazy. And the car market itself has been going up like crazy. So I'm going to give you guys this example with one of my cars being the Lamborghini SVJ. I purchased that car about 8 months ago for, I want to be more accurate, let's say 6 months ago, for around $680,000 was the purchase price, right? Nowadays, with inflation and everything else going on, the car market has gone up significantly. Along with that, more and more cars are being sold every single day, and the SVJ itself is a limited production car. My car is one of 800 manufactured. I don't know how many here there are in the United States, but I know my car is one of 800. So I bought that car for, again, $680,000, right? Now that the car market and everything, along with the real estate market and inflation is going on, right? All of those cars, again, over time have been being manufactured and continue to be sold. So the supply of the cars that Lamborghini offers now is going to be a lot less significant than what it was previously when the car first came out. And as more and more cars are being sold, the demand is increasing on those cars. So nowadays, if you look at the retail value of the car itself, right, you can go online anywhere and look at the price. I went online, I looked at the price of what my car is selling for now, and it could sell for anywhere between $800,000 to, let's say, $900,000 was the most expensive ones that I've seen. So I could potentially make a $120,000 to $200,000 profit on my car because I bought it before the demand for the car increased, when there was a lot of supply of the car. And it's as simple as that. And that's a real life example, right? Now, that was the basics of how supply and demand works. So when price gets too high, market makers typically, and this is for the example of the market, right? Of any market, stocks, currencies, whatever the case may be, as cryptos. When the price gets too high, market makers look for a desired price to start liquidating their buy positions, which causes the market to sell off. Because you have to remember, for every single buyer, there has to be a seller willing to sell you that contract. So when the case happens where price is too high, let's say gold hit 2,000, right? Again, there's going to be sellers looking to take sell positions at that price, along with buyers looking to close their buy orders, giving the sellers their positions or those contracts, right? That's going to cause a sell-off in the market. Now, the same thing for vice versa, right? When price gets too low, market makers look for a desired price to start liquidating their sell positions, which causes the market to rally. And again, there's two sides of the spectrum. When price is getting too low, like 17, 1800, this is going to be on gold, right? The sellers are going to be like, okay, I sold gold at 2000 and now we're at 1800, so I could potentially make a 20-30% gain, whatever the case might be is, and I'm looking to close my sell position. At the same time, for the people who didn't sell gold then and there, right, the buyers are looking at, hey, gold is at 1800, 1700, I'm going to look to buy gold now and wait for gold to come back up to 2000 to possibly look to close on my sell. And that causes the market to go up. It's all supply and demand. When supply drops, demand increases. When demand drops, supply increases. Now, the law of supply and demand. The higher the price of the asset is, the more the supply will increase. Vice versa again. The lower the price of the asset gets, the higher the demand will increase. Literally, you could just kind of grab this and put a weight on each side, and it's just as simple as that. Supply and demand is a very simple concept. Now, here's some key notes that you should maybe consider, right? Market makers are looking at the bigger picture, and this is when it comes down to trading and, you know, taking supply and demand and putting it into the trading perspective. Market makers are looking at the bigger picture, meaning the higher time frames such as the daily and the weekly time frames. And I wanted to mention this because there's going to be, again, scalpers, day traders, and swing traders trading different time frames. When market makers come to the market, they're the ones moving the market in the direction that they typically want to. And again, you know, market makers are waiting for or looking at these higher time frames, waiting to get in on the best deal possible. And you know, they're not looking at 5-minute time frames. It doesn't really work that way. And again, it works with the overall bigger picture being the daily and the weekly time frame, right? Now again, when demand exceeds supply, it goes up. When supply exceeds demand, price goes down, and it's literally as simple as that. And I just wanted to break down supply and demand so you guys understand why this trading methodology works. In the next videos, we're going to be covering supply and demand and actually implicating it into our chart so we could see where these major supply and demand levels are so you could find future trade opportunities.